All right, welcome back. We're live here on the Milken stage. Sonali Basak, Romain Bostic here now with Kate Moore, the Chief Investment Officer with Citi Wealth. Great to see you, Kate.
Yeah, it's great to be here.
A lot of money has been flowing through the wealth channel as of late. And of course, a lot of that money is coming in at a time when, let's just say, uncertainty, for lack of a better phrase, is really starting to bubble up. How do you sort of thread that needle in an environment like this?
Yeah, look, it's been a pretty difficult message to have to deliver to clients who want to hear about exciting opportunities in the market. And the truth of the matter is we've held steady with this message since the beginning of March, which is now is not the time to add to risk. And even though we've round-tripped since Trump's announcements on April 2nd around tariffs, we still see a huge amount of uncertainty in both the earnings and the macro landscape in the second half of this year, and are just cautioning that we want to be more patient about deploying new money.
So how do you put this into context? We heard a lot from the Secretary of Treasury Scott Bessent this week. Is there a consistent message that you're picking up? Are there things you still want to hear from him?
I will say this. We've heard many messages from members of the administration. Sometimes they are consistent, sometimes they are less consistent. And I think for those of us as investors, we have to ask ourselves the question, what is the general direction of travel, even if the message around certain topics, whether it's around tariffs or taxes or other policy, has changed a little bit on the margin? What is the direction of travel? And what does that mean for overall asset prices and activity? And I think the message should be for all of us, we are in a changing policy environment. And even if it's less bad than people may have expected a month ago, it is still a significant shift for companies. And we don't expect them to be able to adapt instantaneously to these policy changes.
I am curious, though, to Sonali's point, and Bessent, of course, was here at Milken, and he directly addressed the crowd at one point, the investor crowd.
He did.
Kind of basically saying, look, I've got your back I'm paraphrasing, of course. There have been several other members from the administration here this week. They're talking about tax cuts. They're talking about deregulation, business growth. They're not talking about trade tariffs. They're not talking about DEI and those other things. Is that going to be a more constructive message? Should they stick to that message for the investment community?
I think the administration has a very ambitious plan to attack many different parts of the economy and the government concurrently. I think that would be challenging for any administration, candidly. And I do think the investment community, particularly those that invest in risk assets, really want to understand how is this going to affect the bottom line for companies and for corporate earnings across all sectors, not just in the U.S., but outside of the U.S. And that we don't know. I mean, I look at what consensus is in terms of earnings right now, 265 bottom up, right, for the S&P. And I say there's very little probability they will actually get to those numbers. Even before these tariff announcements, we knew the economy was decelerating. We saw cracks in some parts of the consumer. Overall business activity was coming down a little bit after two really robust years. And so I think it's natural for us to want to downgrade that. And now the uncertainty factors and the pause that we're talking about in terms of spending and activity, I think is going to hit in the third quarter.
But our expectations on Wall Street, you seem to be suggesting they might still be too high, because we have seen some downgrades to long-term targets. Also, some downgrades with regards to earnings expectations as well. I know in aggregate, we're still elevated, though.
Yeah, so there's a bit of a disconnect here, right, where the strategists have taken down their S&P targets. Maybe they've taken down their overall earnings numbers. But the analysts who are covering from a bottom up, on each of these different companies, haven't made the same kind of slash and burn. And a lot of that is because they don't know how to factor in all of these macro changes. I can't actually say I blame them. They're waiting for a lot of cues from companies. And companies came out, as you guys well know, during this earnings season and said, we think there might be multiple scenarios, but we're going to hold steady with our baseline for what we expected growth to be 2 months ago, instead of trying to forecast what tariffs might do to our bottom line.
When you're thinking through the investing picture, where's the biggest risk? What is the scenario that you are counting as the worst case at this point?
I think there are two things that I'm sort of really worried about. One is a kind of a right tail risk, where everyone says, we don't really care about the near term, let's call it the next 2 to 3 quarter fundamentals, and that we're going to put a lot more money to work. And you see the market rip significantly higher and a huge amount of multiple expansion that leads to fragility, I would say. The second thing I would say is that you end up getting this pause we've been talking about in terms of investment activity, spending, hiring, really hit in the third into the beginning of the fourth quarter. And that air pocket ends up creating a self-fulfilling cycle. And people see this weakness and then become even more conservative in their behaviors and their management. So, I worry that sentiment, the sort of translation from soft data to hard data, could end up becoming a more challenging period for the economy than it needs to be.
So ultimately, how do you invest through this?
Yeah.
Are there chips you're taking off the table, or are you putting more chips on the table anywhere?
At this point, we're not adding to risk assets, but I'm going to watch very closely and try to get a sense for thematically if there are things that we feel compelled to do. Like a lot of investors who are multi-asset and asset allocators, we've been sort of looking at the shorter end of the curve, recommending some of our clients keep powder dried, keep their cash in yielding instruments, and wait for better opportunities. But I will say this, when I look around the world, there are still incredibly high quality companies that should be able to sustain their earnings growth, even in a tougher economic period. And some of the things we've been talking about with our clients, including last night at dinner, were frankly that there are areas of spend that are existential for most companies and industries around technology and AI, around certain software and services that even in a weaker economic environment, we think this will trickle down to these companies.
Geographically,
Yeah.
is there more opportunity overseas? Because you look at the outperformance, at least in public markets, of European public markets relative to the U.S. public markets, and there's been also a lot of outperformance to a certain extent in certain private assets in European markets as well.
Yeah, that's right. Yeah. I would put this into two different buckets, right? The first was pre the April 2nd tariff announcements, when you saw a lot of portfolio rebalancing. That makes a perfect amount of sense. The U.S. had outperformed for a huge amount of time. People were kind of asking themselves, how overweight should I be? Should I allow that drift or should I do a rebalance? Fair enough. Then there's what's been happening a little bit more recently, where people have wondered about the trajectory of growth in the U.S. and whether or not policy, and this is a key one, both on the monetary and fiscal side, can support the U.S. economy and markets in the way that it might be able to do in other areas. Here's my challenge, though. Even when I'm looking at relative valuations, index to index, you have to quality adjust it, right? You can't just say, hey, one company or one market is trading 3 or 4 points lower than another, and therefore there needs to be a convergence. There's usually a reason for that. And in Europe, the highest quality companies are trading at a premium to the rest of the market, more along their sort of US peers. So I don't know that there's as much great value there as the index multiple suggests.
It's interesting. Your colleague, Vis Raghavan, on the investment banking side, made this comment yesterday that he's concerned about a trust deficit.
Yes.
This idea that our counterparties are going to start losing faith in us as a trading partner, and therefore it could create a really large difference in the way assets move around the world. How much of a long-term problem does that create?
Yeah, it's a great question. And I would say in the very near term, this sort of pause in overall activity, I think we should all expect that in the third quarter, regardless of whether or not there's a rebound later on. But over the medium term, I think what Biz was referring to was kind of over the next 2 to 3 years, companies are asking themselves not just, should I onshore in the US? Should I realign my supply chain? But who should my real corporate and trading partners be if we don't know what US policy might look like or whether or not they're going to have the same kind of relationships with us as they have historically? I think that's a fair question. We don't know the answer, but it's something I will also be watching over the next 2 to 3 years.
All right, final question here, and this is the hardball question.
Okay.
This is your first Milken.
It is.
28 years they've been doing this. First time you've been here.
That's right.
What's your impression?
My impression is that it's an incredible flurry of activity and information. I will say it's a great chance to get everyone in our industry together trading ideas. But one of my takeaways from the last few days is that people are looking for the bright spots. There's still a very rose-colored glass approach to some of these structural changes in policy. And I think that that's a little bit different than maybe some of the investors I talk to when I'm in New York.
All right, Kate, great place to end it. Kate Moore
Thanks for
of
having
Citi
me.
Wealth.